I see some green shoots.
We need to have some kind of stupid bar.
I just think this is a classic structure, Lamont.
And I'll show you guys, a little trick here.
When you see some of the stuff that we're working on, you're going to like it.
Hello, Wyckoff Nation. This is a very special episode of the Wyckoff Market Discussion. Today, we're celebrating episode 300. It means that we've been on air together with Bruce for almost 6 years, and that's a very meaningful date for us, to consider. And with that, Bruce, how you doing today on this day with the 300th episode? Any words that you have, reflections?
One very fast 6-year period, and I've enjoyed every minute of it. I actually look forward to these more and more every week, and I appreciate the insights that come from these, from preparing for them, from listening to Roman, from getting the great content from our attendees, and the great chart work that you all do. And so I'm just loving it, having fun.
Well, Bruce, thank you so much. I can't really add, anything else to this, with an exception of I'm really grateful to work with Bruce for such a long time. And I mean, we've known each other for I think 25 years plus or something like this.
Plus,
and
yeah.
So it's been a blast. Whatever it was, up or down, we're here, and that's what's so important. And we're excited every time we get on air to talk about the markets. We are ready, and we're very much excited.
Well, we love Wyckoff. We love Wyckoff. We love talking about Wyckoff. It's just such a mastery path, and so this is part of what makes this such a great thing to do, and why 300 episodes is just a joy. So,
and it's just the beginning.
Just the beginning.
Just the beginning. All right. Wmd Promotion, just because we have a lot of guests today. Welcome. So $79 per month with the expiration in 2 weeks on June 8th. But please be aware that this is the only free episode that we're releasing. The next episode is not going to be free. So you have to sign up for this promotion within the next 2 weeks. Next session, and we're going to highlight this more, is going to be for WMD students. And also, today we're covering different markets in depth. Next session, we're going to cover selection in depth. And this is where we're going to have some kind of special guests. I'm going to talk about this just in a second. But let's just go through our weekly curriculum. On Mondays, we're starting with the Wyckoff Trading Course Part 1, where we discussed Wyckoff Analysis. That continues on Tuesday with Wyckoff Trading Course Part 2, the Practicum. On Monday, also together with William, we are doing the Wyckoff Tape Reading Lab. For those of you who are more advanced in chart reading, this is the class to be. On Tuesdays, we're releasing the Wyckoff Bias Game in the Practicum classes. Wednesdays, you're here, Wyckoff Market Discussion together with Bruce, and on-demand crypto discussion with Alessio. On Friday, Johnny Scan releases his Wyckoff Market Report. Bruce releases 2 products, Power Charting blog and Power Charting videos on Stock Charts TV. So check those out. Those are phenomenal. And during the weekend, we are releasing Communal Wyckoff Watch List, which is created by the students, co-rated by us. And Franz and John are releasing Anatomy of the Trade. In the upcoming specials, June 16 is the start to the Wyckoff Scanning Special, where John and Bruce together will be going through the 4th installment on scanning, a very popular class. So make sure that you sign up and check out our landing page on wyckoffanalytics.com. With this, one more announcement. For those of you who's going to sign up, next class, as I said, is going to be all about top-down selection approach. So we're going to discuss sectors in more details, industry groups specifically, We're going to go through some of the sectors today, and then we're going to go to the stocks level. What are we seeing at the stocks level? What is worth our attention? What could we put on the watch list, whether on the swing watch list, whether on the long-term campaign watch list, whether on the short watch list, and so on and so forth. And we are going to have 3 special guests. Those are our own Wyckoff Analytics team members. Alessio, our crypto expert, who is ahead of our crypto Discord group. Yes, we do have a crypto Discord group. So for those of you who are interested, please go to our website and sign up. Alessio is just a phenomenal talent that has converted so many Wyckoff ideas into crypto world. Then we're going to have John, probably with his own scan. John is the regular contributor of the scanning ideas in WMT. So for those of you who's going to sign up, you're going to see John next week and then every other week. John publishes a very popular Wyckoff market report. The idea behind this report is very unique because John summarizes the market based on the scans of the specific price structural spots that are Wyckoff spots, like spring, upthrust, and so on and so forth. So not only do you receive the whole list on both sides of the aisle, whether long candidates or short candidates, but you also receive a very special Wyckoff breadth analysis based on structural events. And then Franz is going to join us, and he's going to be discussing some of his analytical ideas. Franz leads 2 products for us. One is the Anatomy of the Trade with John, which is the regular weekly installment of post-analysis of the trades that our students in the practicum class conduct. So this is an extremely useful exercise, even to watch, let alone just borrow it from us and do it yourself. And then also Franz is a leader of the process group. So quite a lot of agenda for today and for next week. Make sure that you sign up on wyckoffanalytics.com. And with that, let's go. Let's discuss, first of all, the long-term trends. This is the chart that we've been discussing for quite some time. And usually, it's better to start here. What do I mean by that? We need to understand the nature of how big, huge trends unfold and what drives them. So if we would look at the trends, which is at the trend that is a secular trend from the low of 1932, you could see different periods where the market is rallying and the market is consolidating. Those big, humongous structures that last for, let's say, a decade or 2 or more, usually related to the specific generation. Like in the 30s, 40s, the mega structure that was followed by the subsequent rally is related to the silent generation coming into the power of generating really good income revenue for themselves. And therefore that drives, as the consumer, they are driving the market and driving specific sectors. Then later on in the 60s, 70s into the early 80s, the mega structure of 16 years resolves itself into another mega uptrend, which is obviously being influenced and pushed by the baby boomers. And that rally also lasts more than 2 decades. By the way, compare the numbers, 25 and 26, 12 and 16. So they're approximately the same. And the structure of this is also the same. Uptrend consolidation, uptrend consolidation. Obviously, within the consolidation and within the uptrend, you have a lot of ups and downs. And these are usually more cyclical events that we discuss here in these classes with a lot of details. And then the latest mega structure that lasted around 12 years, and I'm taking a sign of strength and the first backup action as the part of the structure, so please understand that. It has resolved itself into the currently unfolding uptrend, regardless of the COVID decline, which touched the support line, the demand line. We're still in this uptrend, and this is all about the millennial generation. And it's a little bit too young. it's a little bit too young. We are still not over 20 years on this trend. So we need to understand that first before we go to some other ideas. We're going to present to you today multiple ideas, not just one, not just two, not just even three. And all of those ideas will discuss different scenarios. As first of all, to the bias, what could we expect? Secondly, how that bias could unfold also with different sub-scenarios, which is very, very important. So sit back, relax, and enjoy. If we would look at the uptrend that has started from 2009, and we would be thinking that the next supporting point for us is the COVID low, with different touches at the resistance, and the latest one being late of 2021. Then we could see that we're still within the channel of this very much long-term uptrend. So the idea here was that if we're in the bear market, could we potentially touch the demand line in such way that we have some kind of testing action of what? Of this first initial COVID low. Now for that, there would be some kind of requirement, the requirement of the character, a requirement specifically that relates to the volatility. And that's why we've talked a lot about the need for us in the current market environment to have some kind of capitulation event. And unfortunately, we still don't see this. We don't see that kind of like stupid increase of volatility akin to COVID of 2020, or maybe akin to the decline in 2008, where with the speed with which the price goes down is slightly more than 1.5% per day. We don't see that. But how would that happen? If we would look at some of the analogs from 2008, and this is a weekly chart, and we would compare it to the daily chart, which is the most recent structure that has unfolded, we could see just uncanny resemblance. We are starting with point number 1, and from point number 1 into point number 5, we are forming a very similar structures, where we have higher lows at 2 and 4, where we have an upthrust up after distribution at 3. We have a minor sign of weakness at 4, and then we have a last point of supply at 5. Please note that even though there is a structural similarity, we obviously comparing weekly to the daily. With that, from 3 to 6, major sign of weakness, same here, and we just went through this. 7 and 6 establishes the trading ranges, where from 8 to 9, and this was a brilliant call here at WMD, we said that the rally from the sprint position and from the test is going to be the best rally in this trading range. And it happened in both cases. Then a sign of weakness into 10, attempt to rally into 11. All of this is unfolding just like one-to-one. And then point number 12, which I don't have here, with the rally to point number 13, and then collapse in 2008. Now, this is where this analog stops. And I have one colleague with whom I worked a little bit, and I still email with him, and he uses analogs a lot. And he always taught me, use the analogs until they work. And when they don't, go away and find something else. So we're gonna make some kind of case study that maybe potentially we could continue going down here. Specifically, when we look at the breadth from 2007, 2008 into the 2021, 2022, we also see the same type of the resemblance. Please note the moving average and how the breadth is actually locating mostly below it before the actual collapse in 2008. Now, we don't necessarily have this collapse here, and that's what's so questionable. We need to have some kind of collapse where everything is being sold, every asset is being sold. And our understanding was that we're kind of near that, that time of whether either collapsing or reversing. And if we would be collapsing, the analog would continue working and would be showing us the pathway of where the price could potentially come. In 2007, 2008, measured one-to-one move from the top to the sign of weakness, and then down brings us exactly to the first intelligent stopping action, selling climax. And then the price goes into the lower highs, lower lows, which is a very typical price structure when you have such an increased momentum. And this is what was expected. But is it going to happen? Well, we're going to give you something else. We're going to give you some other scenarios. Here's the new scenario that our students from WMD have not necessarily went through with us. So this is something new. Let's start with consolidations in 2010, 11, and 12. As you could see, usually those kind of like cyclical stopping actions have multiple swings, ups and downs, ups and downs, ups and downs. And they usually start with some kind of change of behavior. We were going up normally, and then some kind of reaction that maybe exceeds and shows some elements of the supply. In 2010, that was a flash crash. Then after that, actually right here, a flash crash. Then after that, there is some kind of final retest and final capitulation that happened in 2010, 2011, into 2012, backing up action that happened again in 2014, 15, 16, with 16 being a spring event into the final capitulation with increased volatility. We kind of see that volatility, the final volatility in those events, they are being created at the end. And then finally in 2018, 19, and 20 into the COVID low, we have the same, a change of behavior, a crisis into a liquidity crisis into the end of 2018, and then COVID itself, where we have the majority of the volatility coming exactly into the last leg. What is happening now? We are most definitely in the overbought, overthrown condition as we start this distributional process. But we are not really seeing capitulation here, which might suggest that we might be at the first leg of a much more complex structure. And that's kind of like this new idea that we want to introduce to you. How this complex structure could unfold, we yet have to see. And we'll make a case for this structure now transitioning right now from the first regime, which was a distributional regime, into more of the rally regime, and then it's going to follow again into the regime of a secondary distribution that might have that final capitulation. There are two ways of how the composite operator usually would take the money from the weak hands. Either the composite man would shake people out or tire them out. And as we don't see the capitulation event, so there is no a significant shakeout, at least for now, maybe it will come a little bit later and we will still be using 2008 analog. But wearing them out is a completely different thing. Wearing them out is going to come through a prolonged ups and downs where the sentiment is going to shift from bearish to bullish to bearish again. And this is what's going to be so frustrating. And this is where people are going to lose a lot of money. So here is one of the scenarios of how we could touch the cyclical low before we actually resume a secular trend. Well, let's look at this from the perspective of maybe a historical analog. And this is very interesting. This is 59, 60, 61, and 62. Somebody sent me an analog from 55 and 56, and I believe that's not it. But 59, 60, and 61 into 62 low kind of makes sense to me. And at least for now, we could use this as a hypothesis. So what is going on here? From 1 to 2 to 3, we're developing some kind of distributional local structure. from 3 to 4, a major sign of weakness that starts creating, after the local selling climax, a trading range. 4, 5, 6, with 6 to 7 being that best rally in this trading range. And then we go into very interesting decline. This decline is deep, and it's suggestive of another sign of weakness, but in reality, it just produces a very deep spring. And from there, after a short consolidation, we start rallying up. And this rally develops in a very interesting way as well. After the 18% decline, and please note that here we are declining 20% as well, so very close. What are we starting to do? Think about two things: no capitulation, like in the current structure, and what is the sentiment? The sentiment is of extreme bearish character. What is happening right now is the market. A lot of buyers of the puts. Everybody is right now on the side of the bearish sentiment. And usually that's when the composite man is saying, let me take the money off the table from these people. They are bearish, let me trap them in such way that their premiums are going to collapse and I'm going to take it. So imagine the rally currently in the market where we're overcoming the first high, we're overcoming, then we are creating some kind of test, we're overcoming that test, then we're saying, okay, we're going to go into this resistance area, the price comes here, and then it overcomes it again. How would the sentiment change? Most definitely from bearish to bullish very quickly. And people will start buying here and pushing the price up. And this is where the contrarian composite man is going to start selling. And that selling is going to start creating some kind of stopping structure. That's going to lead to what? To the final capitulation that will have all of the characteristics that we need: increased volatility, lower low, the bearish sentiment that will be even more bearish than it is right now, and a volatile structure at the end of this capitulative event will do two things. A major exchange of shares will happen there, and also that volatility capitulation will happen close to this secular uptrend demand line, which also could be a cyclical low. So again, this is just one of the ideas that we have. And with that, Bruce, this kind of became a rant a little bit, but you know, we're famous for having this type of rants at the beginning of the session. What do you think about this analog and any other ideas and thoughts on any of the previous slides as well?
Great rant, really good. Let's just go back a slide, I think. Yeah, this is good, because there really is an analog for this. There's actually two analogs, and what you're suggesting here as the period ahead, and the first one is this 2015-2016 period, where you have maybe not quite as dramatic as the way you've drawn it here, but you do have a very similar kind of a series of events that occurred the 2015 third quarter low, and you have a rally into the end of the year, and then 2016 is a new lower low. Those were really dramatic big swings. And I'd like to point out that there was really good point and figure structures at the distributional top, and then at that first low that went right back to the high, another countdown to the low. We actually talked about those. I think I wrote about them in blogs. Now, the other one that I think could be somewhat of an analog here, Ramon, is this period from the beginning of 2018 to the beginning of 2020 with COVID low. And even though this shows a series of higher highs, lower lows, which is a broadening formation kind of a structure, is that you can see here that there's kind of a family resemblance to what Ramon is suggesting here going forward. in that you've got a series of lower lows that shakes out the prior low, creates a tremendous amount of pessimism. There's a huge amount of pessimism at the end of 2018. I mean, really, really noteworthy negative sentiment. Then that really big rally into the beginning of 2020, a lot of diverging characteristics at that high. And then, of course, we know the COVID decline had just immense pessimism. So, you know, the public and institutions too were just getting crushed by these extreme trading characteristics. And of course, what we're trying to do here is we're trying to think in contrast to the way that the public is thinking about these, so that we're not getting whipsawed the way these markets are designed to whipsaw people, and the composite operator types are able to extract capital from these people. We want to be with and on the side of the composite operator. So what you're suggesting here, Roman, and then going back to that 50s to early 60s analog, which I think is fantastic, is a similar kind of a thing. But notice this, that there are really great accumulation structures that occur at the low where it says no capitulation of 0.8. And then there is a substantial distribution structure in at the peak there. And then I believe that was the big combination of the Cuban Missile Crisis and then also the steel companies raising prices and setting off sort of a showdown between them and the Kennedy administration. And that was just a wicked decline, but a really great trading opportunity. The trend up and the trend down, very Wyckoff characteristics in both extremes. And then look at this big accumulation structure down here. Yeah, that is very noteworthy, and I think it's textbook. So this is very interesting, and it has the opportunity for us to be able to trade these. But we have to start thinking like swing traders and see, everybody today is equipped with the orientation towards trend following, because that's all that you really had to do from 2009, 2010, 2011, all the way through the end of 2021. But now we're seeing a different set of skills for trading purposes, very much with a Wyckoffian orientation. Now this chart here that Roman has put up is a point and figure chart that we've created, which is very simply a 5 minute data. Now, keep in mind that just because we're looking at 5 minute data doesn't mean that we're not looking at quite a bit of data, because we're looking at the characteristics of point and figure, 3-box method, and then 10-point scaling, S&P cash. And so we can see this count is in basically 2 segments. The gold segment is the first one, and that would be my operating count, so to speak. But here, look at what we have created now. This is not through the end of the day today, but you can see this count right here, just this period, which is the last week or so, because of all the volatility that's been in this market. Remember, point and figure is a function of volatility, not time. And there's a count here, and I would say an incomplete count, 4330, 4410. And these intraday counts can be quite powerful swing trading counts. Now, the larger count goes out 35 columns, 4870, 4950, which takes us to a marginal new high. Think back to Roman's analog. Now, the other part of this is that this may be, yeah,
Bruce,
go ahead.
right there, 40, slightly above 48. If we're gonna go, 30% from the low, exactly to your count.
And it very well may be that point figure count grows larger. And so I would just like to point out, Roman, that And of course, what we need to see is we need to see the market prove this count. And that would be by being able to rally up to that resistance area, which is around 40.90. And then note that if it can do that and give us a sign of strength, which is an important part of an accumulation structure, we talk a lot about those, and then pull back. Now we have the potential for a count, Ramon, that goes, maybe it pulls back into an LPS even. And then you have a count that could go all the way over here to the early May, which is that, there you go, preliminary support. And so that all could potentially be accumulation. One of the things we really try to work on is being able to visualize these unfolding accumulation structures before they're complete. And that's a big part of what Ramon does so well with his analogs. And I like to say that I suffer from analog envy because I'd like to be able to do these as well as Ramon does them. But that's part of the joy of being here, because I get to watch Ramon think.
I have a PNF envy. It's official. I have a PNF envy.
Well,
Bruce
is
not just the expert on the PNF. I think that Bruce just stands alone in the whole world, on how the PNF counts are created, how they're conducted, and so on and so forth.
Well, let me say this before we move on, and that is that my goal in life is for our community to all become point and figure master experts, that above and beyond the level that I've been able to achieve. And that is my personal goal. That's why we work so much on these things together. And because I so thoroughly appreciate people like Dr. Hank Pruden, really showing me and our community in the classroom all of these nuances of how to do this. And I hopefully I've been able to even expand on that, but I really want us all to become take it to the next level, let's say. I'll leave it at that.
All right. Okay. Well, let's move on. I mean, let's still continue with the idea that, first of all, we're still in the downtrend. Nothing has been reversed. Nothing has been confirmed. We just kind of seen some short-term conditions that are suggestive that we might have some kind of rally. Sentiment conditions that are pointing that maybe there are too many sellers and we might have some kind of rally here. So the rally needs to be confirmed. But Bruce, if we would be describing again the bearish environment from the very long-term perspective, what would be the signs there? Talk to us about the long-term trends and what those long-term trends would be associated with when there is a change of environment, when there is a change of regime.
Yeah, so this chart is one that we first started talking about in 2020, and it was because of the throw over of the NASDAQ composite above this long-term trend line. Think back, this goes back to 2003 to 2007. You can see the upward stride there. And there was also one back from 1981, 82 up to the final peak in 2000. Now, I'll go really fast here. We have a lot of slides to look at, and this is going to be a big chart feast today, so I'll go quickly. But I want to point out that I have been professionally in my finance career as a portfolio manager and so on, really since the three IPO booms that have occurred: 1983, 84, 2000, 99, 2000.com, and then the current one, social media, however you want to think of it. But these booms were all just crescendos, and Wall Street is very, very good, very clever at doing the IPO booms when the stock market is absolutely at full price, extremely high valuations. And so they are so good at this, at identifying this. Look at how these things crescendo with climactic bullish action in each of these tops along here. And so I actually was very early in my career at the first one in '83, but I was there. I have stories to tell some other day, and also at 2000 and the current one. They're all fascinating periods. But anyway, my point being that if you look at the chart below, you can see the NASDAQ comp to the S&P. And in each case, you can see these relative strength blow-offs occurring in each of these periods, and each is preceded by a little pause, which is the yellow shaded area, which is the calm before the storm of bullish behavior. And we had those in each case, and then the blow off. And here, now note the 8 years from the early 80s to 90. That was a period of rotation, very important concept for us to work on here on Wednesdays. This is rotation away from growth and towards other areas of the market, industrial, banking, insurance, home building, et cetera, materials, inflation beneficiaries, and so on. Then look what happened after 2000 to 2008-9 was a big sag in the growth theme. Growth was just out of favor. It was forgotten. And then for 9 years, it was other themes that just took off. Energy stocks, energy just boomed. There was like these massive moves in energy themes during that period. And you could really see them in the rotational characteristics back at that time. Something like that is unfolding now. And so we are in the emergence of that. We may very well have the analog that Roman laid out, where we get the big boom in the markets, but there's likely to be rotation in the way the next unfolding rallies come. And we want to be sure that we are participating in those rallies by being in the right place. And you can already see in these growth stocks, these massive declines, 40, 50, 60% declines already, and we're hardly off the peak. So anyway, Roman, I'll leave it at that. You may have comments to add.
Let's go
also,
forward. We're at 337. So
yeah, go ahead. There was also, this is just an update of that chart. And so, and hit the space bar a couple more times because those lines.
Okay.
There you go. And so look what happened since. This chart is through May 25th. And you can see the big breakdown now where in fact it's broken. I think that we've had the IPO blow off and now we're starting to rotate towards other areas, which is what we just described. And so it's already started.
Absolutely interesting. Just, those conditions under which we could observe, the change of the regime, and definitely IPO is one of them. And then Bruce, what about the long-term chart? So here you have the S&P and the NASDAQ composite. How are you going about this? Are there any specific points that you could show us that would tell you like, yeah, we are in some kind of new regime?
Okay, so let's start with the chart on the right, because you can see there, this is again the NASDAQ composite. We were just talking about it on that other chart. This is just more granular in terms of seeing what we saw on the prior chart. And there you can see that not only have we come back down into the long-term channel, and this channel goes back to 2010, 2011, and look how beautiful. This is textbook Wyckoff channel construction. It's fantastic. And once we got back in, and we've been looking at this chart for a while now, before it came into the back in, it was in a overbought, buying climax, throw over situation. Now it's back into the channel, and we had warned that once they come back into the channel, that the declines back to the bottom of the channel can come very swiftly, quickly, with high degrees of volatility. And you can see that in the prior declines from the top of the channel to the bottom. But now we've gone from a throw over condition. Now look at how in two legs we've gone so quickly down towards the bottom of the channel. And here we are, Roman, we're very, very close to hitting the bottom of the channel now. And this rate of change underneath I won't get into the construction, but keep in mind this is long term. 26-week rate of change, 6-month rate of change. Look how oversold we are getting to be now. This could very well be, Roman, a point where this reversal of trend may start to take hold here very, very quickly, and from a deeply oversold condition. And so I just point that out. And then also note the relative strength climax underneath here in the NASDAQ composite to the S&P. Look at the immense relative strength blow off there in 2020, 2021 into a buying climax, automatic reaction, secondary test, and then look at this immense failure of relative strength. The themes that are in the NASDAQ composite are really getting beat up. And let's just leave it at that. Now, the S&P, which is more composed, yes, of the growth names, but also a lot of industrial, other themes, energy, banking, and so on, it is also became overbought through over the Keltner channel, also through over the trend channel. And look how close it's getting after just turning back down very hard towards the bottom of the channel, is getting to that classic oversold condition at the bottom of the channel. And therein lies the potential for maybe a more important rally occurring very, very soon from around this level. So Roman, your thoughts.
I was looking at this, Bruce, and I apologize, guys. I had to step out for a second. I'm not feeling well today, so just had to take care of myself a little bit. But Bruce, what would you say about MACD reading here at the low and the current reading?
Yeah, so the thing about the MACD, especially here we're looking at monthly data on the S&P here on the left, is I like to look at the MACD on a very long-term basis, and notice how the signal line across there, the histogram, when it does tend to go from negative to positive or positive to negative, that tends to coincide with an important turn in this very important index. And so you can see, and all that is, the histogram is just following the turn in the MACD to its moving average. But it really is a nice visual. And look, it's very negative right now. And also it's in a downtrend. So that really belies the idea that we could just continue to get a lot of weakness. But also I'm very attuned to the idea that we're starting to get down into the area of the bottom of this channel, which should produce some kind of a rally. And maybe it's a rally to a new high. Don't know. But we have the super negative sentiment to also accompany this very deeply oversold condition.
All right, let's continue. And if we still have some kind of potential, to go to the downside, what are the targets there, Bruce? And then obviously, anecdotally, talk to us very briefly. We're at 343 about the conclusion of the rally that we had prior to the distribution.
Yeah, look at, and I'm very much of the belief that you have to have an important cause that precedes an effect, the effect being a markup or markdown. And so you can see there, look at that beautiful COVID low cause that is measurable, countable on a point figure, gives us a count to 34,000 to 38,750 with a midpoint of 36,375. I always put in the midpoint if it's a wide count. So bang, went right to it, really impressive. Then the count inside the channel, the upward channel, and I didn't have time to mark this, but I tend to count distributions very carefully because you can overcount. But this little count here that goes across 3, 6, 7 across counts down to about 30,000. And that's just that little area that's right inside the channel and on the Dow. And then there's another count in the Dow that also confirms that right over here. Yeah, and so there are counts that are close to being fulfilled. And take that Dow chart and just delete it or shrink it, Ramon, if you can.
Ooh, I probably cannot do this, Bruce. This is in the view mode right now, so I can't edit it.
Oh, okay. All right. So we'll just take the charts on the right. You can see that the chart up here at the NDX on the right in 2 counts goes, and I apologize because I thought we could just shrink it, but the NDX on the right, you can see in 2 counts, it's gone down to the redistribution area in that purple count. And then the second count across, which is the redistribution area, counted right down to this 11,400. And I would call where we're at right now, Ramon, a hit. We've hit the lower targets of the count of the redistribution. So that I think is really important.
When we hit the target, Bruce, what happens? Or we're in the vicinity of that target?
That's really important because we build a cause. And so we will build a cause on the redistribution count, and that count will, and I actually have these slides up here so I can.
And while you're looking at this, I'm going to answer really quickly a question from Chris. Don't we need a better base, like a double bottom, to launch a significant rally? Right here, Bruce was showing us, this is the current count. Yes, it is on a smaller time frame, but this count shows us, potentiality for, 2 types of moves, to the lower high and to a higher high, and it's still within the structure of what we've just had. So it's not necessarily the rally that's going to extend too much away from the trading range. No, it's just going to become a part of the trading range. That was kind of like an idea. So it's not a significant rally by any means, I would say.
And Chris, your point is good, because also keep in mind that count could become bigger, and confirm what you're saying. And I tend to agree with what you're saying, is that you want to see a demonstrable count, measurable, and we look at those every week here. And so this chart on the lower right, you can see this is the IWM, which is the Russell 2000 ETF. And so you can see, look at the first count off the peak, counts right down to where we are. And then you have a stepping stone count that goes slightly lower down to 150, 158. And let me just tell you where it is right now. And the IWM is made a low of 168, and now it's trying to turn up. So this lower count, look, it went right to 168. That's exactly where the count went to. So it might be that I'm actually too aggressive on my redistribution count, or that it may come later. But so far, we're holding this larger, more important count at the highs, which is really impressive. And then on the end, so anyway, those are the most important. We'll come back and look more at these next week also.
All right, 348. Okay, let's talk about other potential analogs. We've discussed ARC a lot. We actually had the anatomy of the trade in ARC. So this is where, as the whole group, with the whole class, we have the voting as to what kind of trade we're gonna pick, where we're gonna enter, what we're gonna do, add or trim. It's kind of like a fun exercise together with students in this class. So we were trading short in ARC, I believe, Bruce, help me out, I think somewhere here. That was the entry, this was the exit. So this was a very quick swing trade, but the key was just to identify the correct environment, the correct point of entry, the correct exit, and so on and so forth. But it's not about this trade. There is an uncanny similarity of ARC, of current ARC chart with the NASDAQ 2000-2003. I'm sure that you've seen it somewhere on Twitter. Many people actually kind of had the same type of the idea. So even though it is an original idea in this class, but it's popular everywhere else. So major sign of weakness into 2, then sprint event into 3. We kind of have all of this. 4 and 5 create, this smaller range in the upper part of that trading range. 6 creates a sign of weakness, and then we go into a downtrend. our point was when we started this trade right here is that, well, we're going to trade just swing trade here, but also that like in 2000, we're going to have lower lows. And look at point number 9, how amazingly accurate this whole analog is, especially after 7 and 8, 7 and 8. But to me, Bruce, what this chart is telling me that 9 is just an attempt to stop. It's not the actual stop in action where this is the lowest low. This could be just the first attempt to stop just because we are at the extremely oversold, extremely bearish low. So intermediate selling climax, not necessarily a terminal selling climax, which occurred back here in 2002 into 2003 March low. This was the trading range of interest to us. So there will be much lower objectives. And what do we see in 2000 out of that oversold intermediate selling climax low? A very sharp rally. And where is the target for this rally? Or at least where was it? Somewhere around point number 7 into that new high. So point number 7 is somewhere here. So from, if I see this correctly, from 35 or 40, where we're currently in, to about 60. That's a very sharp rally of about 50%. And here's an idea, because we are discussing a lot about, the long-term switch, the long-term rotation from growth to value. But periodically, growth will outperform. And it will outperform not necessarily for fundamental reasons, but more for technical reasons. Whenever the asset is extremely oversold, you will have moments in the bear markets where technical rallies will happen. They will be very sharp, duration will be very short, and they will be very much momentum type of rallies. And I think that, potentially we could have something like this in ARK and in other growth stocks. So that's why a very counterintuitive idea on the selection. We'll talk about this more in the next class. Some of the growth stocks actually have potential for a very, very good swing trade. So I just want to put this in your minds. And also, we want to make sure that the low has been created from some kind of causality. So for instance, if this is the cause, could we drop down exactly to this point and then start consolidating or start rallying in a more meaningful way? And from that, Bruce, did we hit the target here for us to say that maybe, yes, we are in the oversold, reached the target type of zone where this rally might happen?
There you can see in that point figure work, the redistribution count across there and accounts down to the area that we've just approached, this point number 9, call it. And that the thing, and I would just, just to reiterate Chris's point, if there is going to be a deviation from your analog here, it's going to show up as some kind of a basing structure. And as akin to what happened in 2002-3 in the NASDAQ, and so you'll get some kind of a cause building process for a more important rally. You can definitely get good counter trend rallies in bear markets that can be quite impressive. And also keep in mind that speculators are go back to their favorite old stocks, and this is the way they tend to trade. And so they're going to go back to what worked for them before, which was the stocks that were hot in the bull market. Those stocks are in ARK. So ARK to us is just a reflection of these super growth names, these disruptive stocks. The fund, when it worked well, it worked really, really well. And when it stopped working, it's just a surrogate for what's happened to all these stocks. And ARK here, I'm showing a high of 159.70 back February a year ago, and then we just hit a low at 35.10, 159 to 35. And so that's pretty darn impressive as a decline, but it also expresses the amount of damage that's been done in the space. And so, yes, a sharp rally could come. And if it does come, that means it's not sustainable. because we need to build a really important markup phase on a good basing structure, a good foundation.
I remember this market, Bruce, in 2001, 2002. It was a lot of fun to trade, first of all, especially if you're a swing trader, because you have those sharp rallies, and then you have like deterioration, and then sharp decline. So if you're a swing trader and you understand how you apply the Wyckoff methodology, you could trade this, and you could trade this very successfully. And then once you see that there is a much more proper bottom information for the long-term campaign, this is where you're coming in, you do your PNF, and you say, yeah, from now on, we are going to go up. That's number one. We are going to outperform. So there's element of the selection and strength or weakness on a comparative basis, and we're going to reach specific targets. All right, well, let's move on. Let's talk about this fascinating analog. You're saying that you have analog envy. I envy this chart.
I think I did this because I wanted to try to keep up with you somehow. Anyway, so I'll go really fast. You may have seen this in the past. The top chart is the Dow Jones, 1917 to 1920, the Spanish flu pandemic. And so it occurred to me that we need to compare that period of that flu pandemic. I mean, a really horrible worldwide pandemic. And you can see that the low was put in. Now, the flu, the Spanish flu is already raging at the time that the low was put in, but the first recorded case was at Camp Funston in Kansas in 1918, March 11. And so I point to where that was on the chart. So you can see how the market went up. And this is just a potential roadmap. So then you have peak to trough, 685 days, trough to peak, 685 days in the Spanish flu. And then comparing the NASDAQ 100, we have two peaks there actually, and I have the red arrow at the first peak, 606 to 645 days trough to peak, slightly shorter, but there's definitely a family resemblance in the way both of these markets strided upwards to their final high. Then there is a distribution type structure at the high, and then thereafter it starts to go down. Then on the next chart, we have the Spanish flu to the Dow today, and 685 days back then, 652, little closer in terms of the time frame, low to high, but also the distribution in the Dow today is a little different. I would say the Dow stocks are, today are maybe a little bit more mundane, more mature. Back then, those were really the most tradable stocks in the market, were those big Dow stocks in the 17 to 20 period. But look at the distribution forming in both, and this is as of April 5th, I think, is when I put that chart up, so it doesn't show the latest action. So then I think if you hit the space bar, we can see what happened since. I think that's the case, or maybe, yeah, there we go. So then what I did is I tried to do an analysis, Wyckoff analysis of the structure. Now this is the Spanish flu period, and you can see that Wyckoff structure of the distribution, which we pointed out earlier, and then the decline that occurred, and there's the big climactic give up at the end, which Roman was talking about, that we haven't seen yet. We may not see it right away if his analog works out, but look at the accumulation. Always will see a cause built, an important cause, which is definable, measurable, and you can see what a beautiful structure that was, and it led to a new glorious bull market that came later. And so that is ultimately what happened after the Spanish flu. And so we may very well be having a very similar analog today with the COVID pandemic to the Spanish flu pandemic from the perspective of the market. And so we can definitely keep track of that. I encourage you to, keep circling back to these charts and looking and seeing how they're unfolding in comparison.
All right. All right, let's go and talk about the market breadth, right? So there should be some kind of confirmation of either one scenario or another, or maybe some other thoughts that we could see here. This is a very regular view for us. This is percent of New York stocks above their 200-day moving average. And there are very, very important, kind of anchor points for us here. First of all, the analog of breadth since the 2020 COVID low, this extreme rise that we have seen into the 90s, is very analogous to the rise that we've had since 2009 low as well. So this is going to be, kind of like a fundamental reload by institutions where they are buying the shares at the very extreme cyclical low, and that produces this humongous and quick and fast increase in breadth, where we go to the 90s right away. And then the rest of it is going to be more of the deterioration. Deterioration in the breadth, where there is a rotation and money go to now specific themes. And maybe into the end of some kind of meaningful move, the money go into some kind of flight to safety, flight to quality. So where we are right now at 25, Bruce, we're definitely here in the oversold condition, but we've been there quite a few times. We've definitely touched 25 on multiple occasions. I would say like something like this, something like this. We definitely see more of the price destruction right here. So what are your thoughts on this indicator?
Well, it's one of my favorites, and I really like to look for divergence, confirmation, non-confirmation in this indicator. We look at it repeatedly, sometimes in a very short time frame. We actually have a couple charts maybe we can look at if we have time. But here, note how getting down below 10% often is accompanied by a climactic low. End of 2018, that was a huge climactic low in there. And yeah, of course, at the COVID, and then also 2011. And so that it can be a great confirmation of climactic behavior is in the breadth and the deterioration of sentiment into those climactic events. So, and Ramon's point is very good. We don't yet have what appears to be a climactic situation here in the decline. Most of the time, when you start going south like this, you keep going till you get that. So if we get that counter trend rally, Ramon, that could go up to the prior highs or higher, that would be, I think, really throw people for a twist in their trading, because I think people are really, really short right now.
Yeah, there's too much money in, for the composite meant to pick up. All right, well, then we go to a slightly lower time frame. These are the same New York stocks that are above 50-day moving average. So we are looking at the shorter term picture. And we could talk about other things here. We could talk about the trending environment, that is all of this right here. We could talk about the deterioration of the trending environment, which is kind of like its own sign of weakness in breadth. But there is a lot to be said about the initial signs of the divergences, where we have the higher lows being formed on the breadth, and maybe still low lows in the index. So Bruce, you described those so eloquently. Are we seeing this correctly here?
Yeah, so we just really look closely at these. There's a couple different ways we look at breadth. This is one of my favorites, is to stocks above their 50-day or 200-day moving average, because it's a classic trend indicator. Note here, the reason we were able to pick off this really good rally in March was because we taught, and I actually I think I wrote a blog, but I definitely talked about it in power charting video. green shoots. So look at the green shoots from late January to mid-March, where you had higher lows in being formed in the indicator and lower lows being formed in the index, and it led to the most important rally that we've had of the year so far. And then we had not a non-confirmation at the high, but we started to make a series of lower highs off the peak in late March. And so that was confirming deterioration. Yes, and you can see it right there. And down we went, and we've had a very important decline since. And the stocks below or above their 50-day has really deteriorated, got into the low teens. So, but now look what we're getting. We're getting a lower low here, most recent low in the S&P, and a higher low. And now we may get a few more of those, but there's definitely the emergence of green shoots where there's a greater number of stocks above their 50-day than there was at the prior low, which shows that some stocks are starting to buck the trend. So this is, I think, very speaks to the idea of a potential rally situation developing in the near future.
Bruce, what else I like about this most recent picture is the expansion of the breadth here. So from like 12,
Yes.
11%, we go to 25. That's a significant increase there. And
Yeah.
we do have those type of rallies that are showing some kind of ability by the stocks to rally first before going in a much more substantial rise, which comes later on. And the market is still showing us, some lower lows. So there is some buying, and it's very, very logical, by the way, guys. Why does this happen? Why does this higher lows happen on the breadth prior to the price? Because institutions buy on the way down, and before that absorption process is complete, the price still could go down and the selling could deteriorate, and we could see on the way down the emergence of the demand. But the breadth is kind of like an x-ray that helps us to identify what is going on under the hood, right? So somebody's buying already because the breadth is improving.
And we know that the CO is very stealthy about how they accumulate the shares of the stocks that they most favor at a point in time. So they will use the weakness of the market to accumulate their most favored high value positions, and which is exactly what Ramon said. And we talk a lot here about directionality. And once you get a trend up or down, you want to be very respectful of the directionality of this indicator, because the market will tend to follow the directionality.
Excellent. All right, well, let's talk about the sentiment now. So we do talk about the sentiment a lot because Wyckoff Method, as we've stated many times before, is in essence a contrarian method. So you have to practice not just on the technical level of identification of the price structure, what the volume and spread is doing, what the relative strength is doing, but also practice identification of the correct sentiment at the correct price structural spots. And usually we wait for those extremes. And Bruce, what did we hit 8 or did we hit 6 at this most recent bottom?
I saw a 6. It'll change intraday. This is an end of the day. No, it's not even in the end of the day. But that we were able to capture the 8 as a screen capture. But I do believe we saw a 6. Doesn't matter. But but you also can go in. If you go to the website, you can actually hover your mouse over the this chart, and it'll show you the low and it'll show you the highs and so on. Yeah, so I think that you'll see that.
By the way, 2020 was at 3. We hit just recently 6. So this is a very interesting phenomenon, because when you look at the way of how COVID law was formed, There is a lot of violence. There is a lot of aggression. There is a lot of price movement. There is a lot of momentum. And here we don't necessarily do that. And that's the character of this bear market. It's going down. It's kind of going down slowly on the indices. It's going much faster with specific stocks. Like you look at NASDAQ stocks, individually, they're just like dropping down. I mean, like look at PayPal. It's just like almost like verticality down, something like this. Look at Walmart just recently, the most recent, like 5 days, vertically down, and so on and so forth. But when we look at the sentiment, 6 is pretty low. And this is where you have to kind of shift your mentality and start thinking about, is the price structure, is the price and volume relationship is showing me some kind of deteriorating conditions of selling just because everybody already have sold, and maybe some emergence of the demand. Bruce?
I think that one of the keys here, you have to think about sentiment as an environmental indicator. It's not, I mean, I used to really look at the put call data very, very closely. I did it all by hand. I'd get it out of the paper and I'd look at the volume characteristics and so on. And I could almost pick off the day of the high and the day of the low off looking at the volume characteristics internally. But normally you can't use sentiment that way. You have to look at it as environmental. So what do we have here? We environmentally know in this time period, this time frame, that sentiment is very extreme, very pessimistic, and that it could suddenly produce, we don't know exactly when, we might be able to pick that up in Wyckoff analysis of the bar charts, something Ramon and William do so well on Monday mornings, is do it in the tape reading class, and you can develop those skills. But we do know that everybody's leaning to one side of the boat and the boat's tipping. And we want to be really careful because we don't want to be caught with everybody else. So if you are a short seller, you just want to tighten up your stops, be super disciplined about protecting your profits and so on, because you're not alone out there. There's a lot of people doing what you're doing. If that's in fact what you do. Mm-hmm.
And as we look at the most recent data here for put and calls, I mean, like this is exactly what you and I talked about like a month ago.
Yeah.
That the high in this indicator is going to be lower than COVID, and it's going to be somewhere on par. And we were thinking that it might actually overcome this high and be somewhere in this area right here. Now, I have a hypothesis of why it didn't do that. Well, first of all, we could still go there. We could still drop from here.
If we get a climax directly.
Yeah, if we're going to go into capitulation, that would be it.
Yeah.
But also at the same time, I'm thinking because we don't have a capitulation, we don't actually go there. It's kind of like an interesting observation here.
Yeah.
So,
yeah. And that's the reason that maybe you don't want to like cover all your shorts. You just want to become super defensive. You just want to protect. If the market starts to move against you, you just want to make sure that you can lock in your profits. That's all. And
would you say, Bruce, that tactically this is the environment? I mean, like currently today is the environment where you could have both shorts and longs at the same time?
Oh, for sure. Yeah, I'm seeing things to do for sure. And also, like, note over here on the left side of this chart, look at those two big peaks that are roughly in the area that we're at right now. See in the green, which is the 10-day moving average. This is the far left side, way over on the left. So you can see those two peaks right there. And look at how those are accompanied by important causal lows in the structure. So you can see the bases there, and they both result in rallies. So we are going to get some kind of a basing structure, and may get it from this level on the put call, or we may get a further decline, then we get the basing like we did with COVID. Because remember, I showed you the point and figure chart that we were able to get off of the COVID low. And so we will get a cause. We will build one at the final low. We're getting something akin to green shoots in here. So I'll just leave it at that for now, but we're going to watch that really closely week to week and try to identify a mature, complete causal accumulation structure that coincides with the extreme fear that's in the market.
All right, pretty fascinating. Okay, let's talk about the bullish percent, Bruce.
Yeah,
Do
so
we see
another
the confirmation, that we saw in the breadth picture?
Yeah, so here's another way to look. Now I'm putting on the same chart. I'm showing NASDAQ 50-day stocks above their 50-day on the left, and then we're showing on the right the bullish percent. And bullish percent is a function of point and figure breakouts in aggregate, the whole number. So this is all the NASDAQ 100 stocks, and the computer counts them. So it's very mechanical. Well, notice this. Notice how in March you had a higher series of, you had a low late February, then you have a higher low. And now this is true for both the percent of stocks above their 50 and the bullish percent. They both confirm each other. And this is while the index is making lower lows. And then you get a very important rally into an extreme overbought condition, which was a very tradable rally, which we pointed out. And so green shoots. Well, look what we have now. We have a low, very extreme low, below 15% on the bullish percent, extreme low on stocks above their 50-day, which went below 7.5%, very washed out, very less than 7.5% of NASDAQ 100 stocks, or this is actually the composite, so all composite, even worse. So less than 7.5% of all NASDAQ stocks are above their 50-day. That's a confirmed near-term, short-term downtrend. And so that's bad stuff. And look how quickly you went from over 60% down to below 7.5 on the chart on the left, the green line. Well, but now we're starting to get higher lows while the index is making lower lows. So something's going on underneath the surface. That very well could be what Ramon's point was about. We could get a nice bounce out there, maybe not this minute, but somewhere out here in these washed out, really washed out, sold out NASDAQ growth stocks. So, and we may get a couple more divergences before that's ready to happen, but there we are. Here's the S&P advanced decline. This is a 4-hour advanced decline on the left, 2-hour advanced decline on the right. And I just want to point out that the comps on the right, and then the NASDAQ or the S&P on the top, and the oscillator below is actually New York Stock Exchange advancers minus decliners on a 10 period. Now it's 4-hour data, 10 period moving average and a 50 period moving average. So that's of the 4-hour data. But the point being, and look at the blue line, look at how it's had a really sharp advance here in May off of the low, extremely oversold. And then when it comes back down, new lower low in the S&P, higher low in the advanced decline. So this is a bullish non-confirmation. And so that means internally that there are New York stocks that are acting better or starting to improve from the way the index is acting. And then on the right, same idea. This is just 2-hour data instead of 4. Same idea, less history. So you can see it, but look at the low back first week of May, higher low, and then another higher low. And so this is another green shoot situation. And also note how the comp is going down and testing prior lows, but it's not breaking down yet. Could break down, but so far there's internals that seem to be suggesting some kind of repair work going on. So, and we tend to look at this data a lot. So,
yeah, I love this pickups right here from oversold, very aggressive rally in the breadth, while the price is just basically showing nothing. So you can't see this from the price. You could see some demand coming in, and I mean, like if you guys interested, just go to our Twitter and look at some of the old, not old, but the clips from yesterday and from the day before, and on the tape reading, analysis, you will see that. But
now,
these are very significant, in terms of the breadth.
Yeah,
expansion.
and so just as a comparison, or look at September on chart on the left. This is the New York. Look at mid-September. Look at the low there. So big oversold right there mid-September, and then a very sharp rally, little bit of a rally in the index, and then the index goes down and makes a lower low right there, and a higher low in the AD oscillator, and then look at how that just kicks off a really sweet rally in October, November. So, I mean, we don't know what kind of a rally we could get off something like this, but you know, we just want to be really focused on these internals.
All right, great. Let's talk about Wyckoff labeling. After all, isn't it why you guys are here? You came here to the Wyckoff event. Well, obviously, we are taking a lot of ideas and we transitioning those ideas into our Wyckoff conceptual understanding. But Wyckoff labeling is purely Wyckoff. I mean, like there are no other methodologies that discuss the market like this structurally. Maybe Elliott comes, to a certain degree, also discussing the structure close to that. Here, Bruce, we have all four: S&P, NASDAQ, Russell, and the Dow. So we start with the distributional formation. The main event here is the upthrust after distribution, after the stopping action. By the way, we've identified this last bar on November 5th as the bar that's going to unfold this whole series of events. First, the trading range, then volatility, then the major sign of weakness, then the redistribution, then the best rally in that redistribution, then the continuation to the downside. So let's see where we are. So I would say like we clearly see the trading range here, so a selling climax. And I usually label this as a major sign of weakness because it shows the switch from the upward bias to the downward bias. It confirms it. So definitely major sign of weakness. You could have a small automatic rally here, secondary test, phase A, and then you have some kind of upthrust. At the time, you could label this as a potential phase C, and you still would be making money. This is one point that in WTC classes I make so many times. Labeling is overrated. You guys should be concentrating on the analysis of the chart and tactical execution rather than thinking about, oh, here's the schematic, so I need to follow this. Some local sprain plus the test, and then we go down. And then, Bruce, so here's an idea. What if we rally here? So first of all, where would we rally? There are multiple points here for us to rally to. For instance, all of those are areas that we would be thinking about where we could potentially rally. Resistance number 1, resistance number 2, 3, 4, and 5. We could most definitely overcome the first resistance just because it's easier. We are in the oversold condition. If demand comes in, we could go through that. I think that a very important bar in the decline was this one right here. This shows such a clean break. It has some intensity to the downside. So resistance number 2, overcoming that would actually suggest a much more bullish rally. And from the best rally that we have had, we might actually have even a better rally. And if we do have that, then we'll start talking about a change of behavior. And that could resolve itself in multiple ways. We could, for instance, have some kind of attempt to go down first, creating a much larger structure, a structure within the structure, or like in what is it? Was 1956, 57? We could gradually go up, gradually go up, gradually go up, gradually go up into some kind of upthrust, and overcoming all of these points of the resistance if the rally is going to follow, that type of analog that we have had. So from that perspective, it's a very interesting point here, Bruce, as to how we would label this point, because everything else seems to be like understandable. If we have a rally, this automatically will become a spring. I don't necessarily like the spring, it's too deep. I don't want to call this a shakeout. Just because of this overextension, just because there is no confirmation by the volume signature. I think we're going to end up calling it a spring if we have the rally. If we are consolidating here, and then after that we're dropping down, then this is easy. Sign of weakness, which is the major sign of weakness, last point of supply, trading range, and then just continuation to the downside. So this is kind of like my thinking on labeling, Bruce, and maybe you could take another index and just go through the same exercise.
Yeah, so if we look at the Russell bottom left, you can see there that there's a really substantial structure, and there was a lot of talk about whether or not that was reaccumulation or distribution. Generally, people were thinking of it as reaccumulation, and it would be okay to think of it that way tactically, because the whole idea is that when you start to get evidence that that's not the case anymore. And so the only thing I'll point out here, Ramon, is that when you had that throw over in the Russell, which was an upthrust after distribution, and I'd like to point out that the upthrust after distribution in the S&P 500 is that the aftermath of that upthrust and then the test and the failure is exactly the way a UTAD should act. Because think of the term, upthrust after distribution means that the CO has basically disgorged all of their stock. And so there's no longer strong hands to support the market because they've completed their selling activities and they can just let the market go down. And that's exactly what happened in that upthrust after distribution. Similar thing happened in the Russell. And what told us that the reaccumulation structure was not the appropriate call was when that bar that broke back in below the resistance level and broke back down, that very big distribution bar right there, and that put it right back in the middle of the range, which was a major act of weakness in this chart. And so sometimes single bars can be very, very important. And
Know it all bar by David Weiss. David gave this definition, know it all bar. So that was change of behavior, know it all bar.
And then there's a trading range with no lift, which has the characteristics of really kind of being under the ice, and then it's just a failure out of the range. And then look at what's happened. Now you've had another redistribution, and it's just stair stepping lower on the way down. So so I'll leave it at that. So very interesting.
I like how the test is being formed here, Bruce. I mean, like if we would be thinking about like, okay, I'll give it to you, let it be a spring. Okay, so how would the spring be tested? The volume on the actual spring has to decline into the test. Do we have that? Yes.
Yes.
The structure should be formed as the higher low on the test itself. We have that. Now we need only confirmation of that. How would the confirmation look like? Overcoming the high between the spring and the test, and preferably with some kind of aggression, whether it's a series of up bars or maybe just one significant bar that would come to the previous resistance, and then it would kind of mitigate the construction of the structure at that point. But that would act as this confirmatory bar that indeed we have experienced a deep spring, a test, and then a confirmation.
And that would be called a number 2 spring because the volume is so high on the spring low. And so it's referred to as a number 2, must be tested. And the number 2 spring, high volume on the low, that must be tested at a later date, which Ramon is pointing out is it is being tested. So and the volume is drying up.
Yeah, I would say that this confirmatory bar is the bar of comfort. This is the bar where you could say, wow, I'm in the oversold condition. Everybody's screening and still to the downside. I might as well start thinking about looking at some of the stocks. Maybe there is something that is outperforming the market, is rallying. And next week, we're going to do exactly that. We're going to look into a lot of different stocks, different groups. So, make sure that you don't miss this. All right, let's talk about yields and rates. Bruce, and we're going to start with the CPI.
Yeah, we'll go really fast here. I know some of you have seen this before, but what I did is I did a point and figure chart because I think you can do point figure chart on anything. And so I actually think that you can tell from the market itself what the economics are. So it's like, don't, you know, and I learned this from my business partner and mentor, Martin Pring. And, you know, just let the market tell us look at all time frames. But here, very simply, what we're looking at is we're looking at the a structure of the CPI, Consumer Price Index, going back to 2000. I counted in two segments. The yellow segment is that count up to where that yellow line is, arrow is above the top of the chart, which goes to 8.25 to 1188 as a potential target range. We hit 790 in February, and then in March, I think we hit 8.25. No, or maybe we hit March, we hit 8.5. So we did hit our target. And then in April, we hit 8.3. So we actually went down a little bit. And so I have been sort of making the case here with our people that we may actually start to see some backing off of the CPI data. And of course, there's nothing good about inflation above 2%, nothing good about it. So we have a job to do as investors to grow our capital above the rate of this inflation, to grow our net worth and be able to maintain our lifestyles and our purchasing power. That's our job here. That's what we got to do. That's what we need to use Wyckoff for. And so I want to really emphasize that, and this is hard, that we're in a tough environment right now. And so I am looking, Ramon, I'm just going to make this one comment and then we'll move on. But I think we just watch the crude oil prices, we watch gasoline prices, because those are the primary inputs into CPI. Very important. They're not the only ones, obviously. But if those keep working higher, we know that all through May, gas prices have been going up just about every day. And that's going to push through the CPI and is going to continue to have the effects on all the components of CPI. And so we may be surprising ourselves with being able to hit the 10 or the 11% level. I hope not, I hope not, I hope not. But so far, we are in this zone and we're at 8.3. We've had a little bit of a downtick. My concern is if we keep getting downticks, like into the 7s or the high 6s, that the Fed's going to declare victory and back off. And that is, unfortunately, the way you solve the inflation, the CPI problem is with recession. And that doesn't always work. So anyway, we're going to watch this like a hawk. But anyway, just wanted to show you this.
All right. So here's the call that I was making around this area right here on the 10-year yield. So again, you know, Wyckoff methodology is very contrarian. So you always see the signs, the emergent signs of the change of behavior, and then you look for the confirmation of that. So what do we see? We see the shortening of the upward thrust, meaning that all of these meaningful rallies are starting to diminish in terms of the progression to the upside. And then you start seeing confirmation as this bar actually told us, like, that's it, this is the top. Then the next bar is confirming, then the next move is confirming as well. So we said a change of behavior that potentially could lead us into some kind of trading range. Now, today was very interesting because we just had the release of the Fed meetings, you know, from the last meeting. And I would say that it's almost as if the Fed is a little bit living in the past. And obviously their data will improve. We don't want to say that, okay, you know, everything is geared just towards the solution of the inflation problem. We're definitely seeing some deterioration in growth. So that has to be mitigated as well. So the idea here that Bruce and I both have been kind of like introducing to our students was that maybe there will be increases in the Fed rate, but they are not going to be as aggressive. Maybe like 225 basis points. Now today they're saying like, no, we're going to go 50. And not only once, we could do twice, or maybe even 3 times. And I think that the chart usually is smarter than the Fed, just because the Fed is somewhere behind. And that's why it makes a lot of sense. And by the way, we're a little bit lower. We're somewhere here right now at we're at 275 today. This is a trading range where we are. So we could go up and up thrust. We could go down. We could up thrust again. We could go down and have some kind of much larger structure. On the much longer term perspective, there is a trading range of its own, and every high and low is being respected. So we just get out, and in front of us, kind of like this resistance cluster with the high of 4%. I think 4% or slightly above it would be something of the highest point that we could go to. And then after that, I think that we are going back into the trading range. That's kind of like a hypothesis that I have and that we have. And with that, Bruce, your quick thoughts on yield?
Oh no, that was great. And we've actually, I don't know if you put that point figure chart in there. Yeah, here it is on the left. And so this is the same data. This is the 10-year yield. And so I'm doing point figure on yield. Okay, so you can do that. And actually it works scary well. And so you can see that distribution count on the left. And this is just a one box reversal chart. And I call it a swing trading chart. But the time frame, look, it goes all the way back to 2016. Look how well this distribution count picked up the falling interest rates into the 2020 low, 2021 low, and then an accumulation structure. And so we've been using this chart for a long time, actually, and I just updated it here so you could see it, but see what happened subsequently. But this, here we have a little hinge, and then out we come in late 2021 out of this base in yields, and a sharp rally goes up. It hit a high of 312, and I had a count range that ultimately went 260 to 340, and maybe we can still get up to that 340 level the way that Ramon described it, but we are definitely in the area of this fulfilling that count. And so here we are, and we just need to see some kind of a new structure, reaccumulation structure or distribution. But you can see that's exactly what yields will do, is they'll create another cause for another move, and we have just fulfilled that move.
All right. And Bruce, last topic for us to discuss, because now I'm realizing, you know what? This selection, well, let's just go into the next class with selection. And for those of us who would love to join that conversation on the sectors, on the groups, on the stocks themselves, join us. And then in the next class, we'll do exactly that. So the last chart today that we're going to discuss is the the inversion of the yields.
Okay, so here you can see that this is just the yield curve, and very briefly in 2022 the yield curve went negative. Now we talked about, because there's a lot of consternation about the yield curve going negative in 2019, and we said, hey, this is no big deal at the time, because look, the 10-year yield, which we plotted underneath, the 2-year yield below that, both were dropping. And so you had falling interest rates. It's just that the 2-year was falling faster, and or the 10-year was falling faster than the 2-year. So that created a negative yield curve. So that was not a tight money environment. Today, look how fast yields are going up. So we definitely have a tight money situation in the market, and this tight money situation this is not a great environment for the stock market in aggregate, is to have a tight money. Not that the market can't rally on tight money, but they tend to be shorter term, as we've talked about today, and so on. So I show you that this negative yield curve is one to be reckoned with. The last one, not so much. And so interestingly, once the yield curve went negative for literally one day, it bounced very sharply back into a positive, briefly into a positive situation. It's still marginally positive. So there we are.
All right. A question from Brian. Are these WMD classes on demand? Yes, they are. So the recording is being put into the Dropbox for you guys each evening after we encode the video. And so you will have the access probably within an hour or so after each session. If you have any questions about the registrations you want to register, shoot us an email at wyckoffAssociates@gmail.com. Go to our website, wyckoffanalytics.com, and then ask us questions. We'll be happy to address all of those. And then obviously, we are extremely happy to have our all the students that have been with us for quite some time, new guests that join us today, and hopefully you've enjoyed this session. Bruce, again, congratulations on episode number 300. What an achievement.
Thank you all.
And
let me just say that, we do a lot of stock work. We look at a lot of individual stock lists. We go through how to identify best ideas from different methods in the communal watch lists and so on. And we also will go into more detail. We covered a lot of ground today. Tend not to cover as much ground week to week. We cover things maybe a little bit more in depth. And so we try to be very thorough about covering the markets every week. Give us a try, be part of our community, and try us out for a few months. And we think that given the environment that we're in, that we're all going to navigate this environment better with our great Wyckoffian structure to guide us. And so be part of our community, and I think that we're all going to benefit greatly from that.
Andrew is asking, are all of these items on the screen included with the WMD subscription? No, WMD subscription stands on its own. It's $79 per month. And everything else is just, their own products, whether they are free or whether they are paid products. So again, go to our website, wyckoffanalytics.com, check it out. If you have any questions, email us.
Oh, and last thing I want to mention is on Tuesday, I did a Your Daily 5 at stockcharts.com, and I did 3, and we will probably work on these next week, but I did 3 prior bear markets as analogs, again, analog envy, and comparing them to the current market environment and just sort of where we are today compared to 3 prior eerily similar bear markets that were notable. And so it's about a 14-minute video. Go check it out. It's free. And thank you. Thank you for having a look.
Thank you guys so much. We'll see you next Wednesday. And again, great to have you here. Bruce, thank you so much for episode 300.
Thank you
until next Wednesday. Bye-bye.
Have a great week, everyone. See you then.